Almost summer. I'm Samantha LaDuc. I am founder of TradeOutLoud and CIO of LaDuc Capital LLC. You can find me on a website for sure. Let me just do that real quick. As well as, this is my website, LaDucTrading.com, as well as a Twitter handle at Samantha LaDuc. I also have another Twitter at LaDuc Trading. Through Stock Twits, and this is where I tweet a lot in regards to macro. I'm a macro to micro analyst, educator, and trader. I'll go into a little bit about what I do, but for those who are interested in why an asset is moving, I like to kind of dig in and look at the macro themes behind it. And my website obviously is where I provide trader education services. We'll talk about that. I have a YouTube, kind of a new YouTube channel. I just put this up. It's getting well received. I'm trying to add some stuff that would give a little bit more flavor, if you will, of news driven trading, as well as macro themes, especially when we had the big downdraft, which I had a really good feel about. So I have some presentations here if you are interested. But for now, I wanted to kind of just go over a little bit of who I am. Let's see if you can get this presentation again. I trade for a living. I support clients who do the same. I would say that my clients in large part are mostly very savvy retail traders. They know about options. Some even practice advanced options, although all of my trade recommendations are based on the underlying asset, in particular the stock, if you will, even entries and exits, which are discussed in my live trading room, as well as when trade alerts are triggered, they are based on the underlying asset. So retail can follow along in that vein, if you will. A lot of my institutional clients, they are not looking for my play-by-play in my trade recommendations. They're looking for my market feel. I have a thing as it relates to market timing calls. It's kind of what I'm known for, and volatility. So they're more interested in more of my market analysis and research, but I offer both retail and institutional services with a backdrop of macro. Macro I call kind of like why. We know sometimes what's moving, but we don't know why. That's the macro. And then the micro is how to trade it. So that's why I call myself a chase, swing, and trend trader, because my focus is on anticipating volatility across time frames. I also will show you today my thing about Timeframe Congruence, which is I put, for clients in my live trading room and in most of my charts, an hour chart next to a day chart next to a week chart. And what I'm looking for is this kind of, current, if you will, that connects them. And then of course, sizing up an option tactic based on the direction that I'm anticipating, whether it be a chase, which is oftentimes based on an hour chart, a swing based on a day chart, and a trend, which is based on a weekly chart. And I have lots of pattern recognition that I use as part of that play, but in large part, it is the same repeating patterns from one time frame to another that I'm looking for the indicators, if you will, to align and fit a macro narrative. And I put all that together in the form of this trader education service. So that's what I do in my consulting role. But what I think a little bit differentiates is that I'm using a macro backdrop, and it was very kind of Mark Chandler to kind of, I guess, encapsulate. I did a Forex interview and he encapsulated this, which I thought was a really good way of putting it, which is I basically operationalize this data, this macro data, into a trade which is retail friendly. So lots, and he calls them undercapitalized participants. That would be retail, right? So operationalizing that data is my way of just saying, I'm good with context. So hopefully you'll get a feel for that today in this presentation. And then we're going to just talk granular about option tactics and what I'm actually using. So my style is macro to micro. I'm going to use that over and over again because it matters. It's my thing, but I want you to understand I really want a narrative to fit my trade setup. I'm just not chasing anything that moves. And it's not all technicals. I use macro. Policies lead price. Earnings matter. That's fundamental. Technical and intermarket are huge for me. I can't enter a trade or exit a trade without, I think, really a good feel for the technicals. And also that will dictate the time frame. And this is about trading on different time frames. My intermarket might seem like, what is that for anyone new? It's relationships. It is the undercurrent of relationships in an asset that kind of, you don't even know it. It's there. It's like when you're swimming along and then all of a sudden there's a current and it's really strong and it might, go against you or pull you down or make you go faster because you swim with the current versus against it. Those are things you can't see, but they are very strong under the surface. I'm really, really interested in underlying currents of the price action. So I use a lot of divergence analysis, indicator analysis, some off the shelf, some that I create. Nothing I sell, by the way. My analysis is just mine. I'm not selling indicators, nothing. Everything is, off the shelf as it relates to my trading room. But I'm just saying I do some kind of nerdy things, and I'll maybe show you some of that today. Sentiment and psychology, I also think is part of the analysis. I'm a mom. I have mom radar. I am definitely looking at risks. In particular, every newsletter I do, retail and institutional, is all about market risks. I want, there are lots of ways to make money. The trick is not to lose it. So my focus is how to know what the risks are so as to be forearmed. I can still be bullish, but know that there are risks, and those risks can create volatility, and volatility reprices everything. So I'm looking at the sentiment. I'm looking at outliers that revert, and oftentimes with velocity. Think right now those vaccine plays that we're all going, woo, ah, the Myrna, the Sorrento, etc. This is speculative .com 2000 era trading. Robinhood traders are alive and kicking in large degree right now, and they are seeing, as well as seasoned day traders. I've been tracking coronavirus vaccine plays since early February. So this is really very much a trader's market, right? But those aren't necessarily investment themes. They are right now highly speculative on the expectation that we might get an actual virus cure. I am not one of those. So this is just a trading vehicle. But nonetheless, sentiment at extremes can create these parabolic moves like in the vaccines that can create extremes that then can be unwound. So I like to get in early and then obviously manage that trade technically with the full expectation that that is high risk and will likely be dumped, like with the many examples, right? Like a pump and dump. And so it's the psychology of crowds. I'm very interested in all of the sentiment psychology. Again, why something is moving. I hope that somewhat kind of tells you about my mindset of how I approach this. So I am very much, since I'm so curious, and I'm really a curious type, I like to call tops and bottoms. And people that, say, oh, the meat is fine. It's true, but it's really, really fun to call the tops and bottoms. And I think it's a lot easier to call tops and bottoms. And the reason why is there are very clear divergences that occur under the surface that I can see in intermarket analysis. So that creates this anticipation that price is diverging across too far away from the intermarket relationships, and at some point it's going to snap back. And that was what was brewing so clearly in February. So this was a really good example of the coronavirus risks, if you will, were one thing that was just headline. And I actually wrote about that in an article for clients, January 28th, entitled The Perfect Storm, Coronavirus and Market Risks. But there's also intermarket tells that indicate that there's weakness under the surface that isn't represented in the price. So I could tell something was going to break and wrote about that on February 18th before the rollover of 35%. And then each day, again, underneath the surface, and clients know in my trading room that I'm looking at these internals to see, are they selling into this rally, right? Or are they buying? Is it accumulation? Is it distribution? Where are the divergences? So that's something that I do that allows for trend trading. It allows for swing trading. And then of course the chases are things that happen, you know, every single day because of some kind of exciting news or a breakout. And I'll show those examples like, you know, that have happened this week that you might have seen. So this is how I look at a trade based on time frame, and I'm looking very much at lawyering a trade, able to see both the bull and the bear argument. You know, want to be fair-minded, if you will, not get on one particular side. But it's clear, as you can kind of see from you know, the market timing calls that I am really known for, they're mostly shorts, and it doesn't mean that I'm a bear by nature. It just means that they're easier to see in intermarket analysis. Tops are processes, bottoms are events, right? So we had that we had the Fed come in on March 23rd, which was Monday, and that put the bottom in our most recent bear market rally. So that was an event, right? $8.5 trillion in a few weeks between the Fed, the Treasury, and the Congress. That's an event. So those are a little bit harder to time than a top. Does that make sense? Okay. So that's, you know, my defense of picking tops and bottoms. And I am definitely looking for risks as well all the time. And that's, I think, a value add, because I'm not just laser tuned to one particular direction. I'm very flexible. So to do this, I think really the toolbox has to be pretty wide. I'm a solid generalist. I am not a macro guru. I am not just, you know, a day trader. I am not just a fundamental analysis. I love to build a case. As I mentioned, with the coronavirus article that I published for clients, you know, January 28th, I was obsessed with this concept. This is part of what I do. I can still see the market going up, and technical analysis is, of course, price action. Options are a way to manage both volatility as well as risk. Pattern recognition helps me identify when to enter, in large part. It's just not what I would call maybe the usual, but that's how I work. It's definitely, it works for me. So, excuse me. How do I find, you know, chase, swing, trend trades? I'm typically, you know, like you, probably very curious what's happened overnight and looking at opportunities in the morning. What is, you know, bubbling up, the cannabis plays after ACB reported obviously took off. We had a value rotation, which was also fabulous, and I was waiting for it because yields were about ready to pop. Yields bring commodities with it and vice versa. They also help the hedge funds, well, not help, they help in creating a short squeeze in hedge funds that then need to cover. So most recently, this Monday action, for example, that we had was 60% long short hedge funds that were covering. 40% were new long positions. So that particular rally on Monday, you know, under the surface, what created so much drama? The 10-year popped 16%. I was waiting for it. Oil was 10% overnight. This was my thesis going into the front month June futures oil roll today, bullish into Tuesday. And I talked about it actually yesterday. Let me see. We talked about it yesterday in this kind of news roundtable that I participated in with Anka, and it was, what's your feel for the week and what's your thesis coming into the week? And I explained that that was my macro backdrop, that I was bullish the market into Tuesday because of this, this roll that would catch a lot of folks in a short squeeze because they were expecting another, drubbing like happened in May. Remember when we had the historic, meaning never happened before, negative print in oil, and it was a phenomenal, move, breathless move. And again, if you're not familiar, it dropped into negative, $39 territory. And this was what prompted a lot of folks to then say, oh, wow, as soon as the bounce is over, we're going to short it again. Anyway, that's getting unwound, in addition to hopes that economy is going to get a little bit better in regards to opening back up, China going back on with their demand for, in particular, gasoline. And this is what one play that I recommended was UGA the past few weeks. And the reason I recommended UGA was this concept, hopefully you can see my chart, that we had a combination of things happening. I didn't want to go and do USO because so much had hit in regards to that, those poor traders, right? That it didn't stop at zero. You heard the sad stories. But I really liked this particular breakout that was happening here. So I said UGA looks like a much better play into 15, and let's see if we can get above the 10-week. That was definitely my recommendation for going long the oil patch, even more so than XLE and XOM, which I happen to love, by the way, because it's not going to go out of business, but it's been sideways. So, that's the frustrating part. But anyway, UGA ended up being, again, a macro theme that worked out technically as well, just to kind of give you an idea. So chases are things that, for example, today, the morning, and this could be random, and I mean it is random, depends on the day. I was excited about Avid. No one's ever heard of, and it moved higher, and I think it still will. I constantly, yesterday.
Hey, Samantha, are you trying to show your chart? We're still seeing the video from yesterday.
Oh, thank you. I'm so sorry. Okay, so I'm glad you said that. Can you see it now?
No, it's you have to hit the screen share button again and
I did.
Switch the. Oh, really?
Uh-huh. Tell me if you see it now, because I did.
No.
No, not yet.
Huh? New share.
Here, let me.
I got it.
Yeah,
here.
let me stop your sharing. Okay, now try it again.
Better?
Yes.
Okay, now we see the chart. Yeah.
All right, so let me know if that happens again, because I have no idea. It says you are screen sharing, so I'm assuming.
Okay.
All right, so that's kind of the macro that drives, some of these. And then same thing as it relates to, things that are moving higher, like an AMD today. Those are chases. I'm not sure how long it's going to be sustainable if I really want to commit to it as a swing, but just to give a little time frame idea, if you will, in regards to the different vehicles. For example, chase, headline driven, versus what's happening in more of a swing trade. Let me see if I can go back here. Okay, I'm trying to get back, just a sec. There we go. All right, so you can see the time frames matter. Hopefully you can see that chart. Dave, if you can just confirm if you can see that chart.
Yeah, I'm seeing the time frames matter slide.
Perfect. Okay, so now it's working. Great. So time frames matter. So I just want to clarify, what does that mean? These are the particular time frames when I refer to. Some people focus on one particular. They're really focused on day trading. Others are more, investors, active, potentially investors that are, looking at longer term, longer duration. I'm not just talking about capital gains as a driver, but just following a particular trend. For me, I think everyone defines this differently. Chases are trades that typically last 1 to 3 days. And I am an options trader, so I use options that are 1 to 3 weeks out. They're often based on an hourly chart time frame. Swings are trades that typically last 1 to 3 weeks, like that UGA, for example, employing options 1 to 3 months out. Again, a little bit more, time in there, and they're based on a daily time frame. Trends, they typically last about 1 to 3 months, and they employ options 3 to 6 months. That's how I use it, okay? So for stocks that don't lend themselves easily to options, like some of these vaccine plays, maybe early on there wasn't really a market for the particular underlying stock. Now there is. Or maybe the IV was a ridiculous, 3, 4, 500, which is implied volatility, which makes it very hard to go directionally. The point is, if they're very illiquid, they're very new, they're very speculative, they're very small, like low floats, you're gonna have a tough time playing those with options unless you go further out in time and use some type of option tactic to take advantage of what's called theta decay. Time creates this loss, if you will, in value in that option, and you need a volatility event that's going to pump it up if you're directional. So that's why oftentimes stocks are they lend themselves to day trading, but you're using so much capital. And options obviously are much more efficient vehicles because they're defined risk. So this is how I'm just kind of outlining the time frames that I use. And I think that kind of is an example I'll show you on the charts. And this is a general guideline that folks need to do for themselves. But I do put it up here because I think it's helpful. In option time frame, world, and I kind of put this as a placeholder, okay? Everyone has to define their own style, not only of education, where you want to get your mentorship, what you need to learn to fill in the gaps, and avoid the gotchas, but also your style of trading. Are you really going to sit in front of the computer all summer, or do you want to set it and forget it? So there's a variability, and it's a very personal journey. That's my opinion, strongly. So general guideline in front of you, option timeframes really matter. You have duration, right? Are you going to anticipate or chase? In other words, are you setting up a play because you expect volatility to come into it? I have a few on the macro side for sure that I'm, expecting there to be volatility. Or are you chasing, something that's moving, whatever it may be, a cloud play, a vaccine. So then determine how long you want to be in that trade, because that's going to create this envelope of your risk management. So a few hours, few days, few weeks, for a few months, just as a general guideline, you can see right across 2H, 2T, 2D, 2W, 2M. So then position size. This is something I think a lot of traders are not sure about conviction and might put really heavy position and don't really have the experience to manage that risk, can't sleep at night, versus maybe too small and not going anywhere, right? Not afraid of the paper cut, but maybe it's not really going to move the needle in the P&L. So that's, again, another really personal decision. But position size often can be really, really based on your confidence level. So is it a set amount, like $1,000, or 10,000 or 100,000, depending on how big your wallet is? Coming up with a set amount or percentage of available equity, and then matching that to the time frame, because you're going to be watching, right? And if you're in a 2-hour trade, you better be watching it, versus if you are in there for a few months. So this is just a little example. You can also, of course, wade into it a little bit, but have to start, at a position size later. These are just kind of a rule of thumb, if you will, that I kind of followed early on. And then, of course, I deviate depending on what's happening in the market and my conviction. But for options, I like to base the tactics on where I think it's going, the price, in other words. So I like to create a strike of where I think that option is headed. And then I ask myself, is it really achievable in that time frame? Do I really think it's going to get there in the next 2 hours or 2 months or 2 days? So that's the big question that I have based on the strike prices. We'll go over that. Date, of course, I've already kind of mentioned how I use options as far as strikes, and some of you know, and some of you are just going to stick with stock. But I wanted to kind of create this overview as a placeholder to really think about. The delta, and I'm sure if you have traded options before, you probably, even a little bit, you know about in the money, at the money, out of the money. So the delta corresponds with that. And this is something where if you really don't, you want to act almost like a stock substitute of sorts, then you're going to go deeper in the money. That's like the 0.75 option. You can get a little speculative, you know, if you got a small position or you're managing it really closely with an out of the money. You're going to get the most eruption in that IV that'll create the biggest return on investment. And it's, for me, it's all about the biggest, it's about the investment return. So I'm just kind of giving you this overview of things to think about in the option world that aren't complicated Greeks. And by the way, my trading room moderator teaches the advanced options in the afternoon class. So I do the live trading room, live commentary, macro to micro. But this is something where if you're looking to create a trade and manage that risk with advanced options, I offer that services as well in the afternoons with my trading room moderator, Archana, who does a great job, especially when it comes to earnings plays, because that's all about, you know, capturing that IV crush. Oh, sorry about that. I think I lost that screen, didn't I? Okay, I'm back. So here's an example of time frame congruence. So we've kind of talked a little bit about how time frames matter. And this is how I do it. You do your own. You figure out what you want to do. I don't want to trade nights and weekends. I don't want to, I'm obsessed as it is with, you know, reading and researching and getting inside of my head. So I really like this 8 to 5 business. This is done. You can do futures a lot more than that. The option timeframes really matter is because you have 3 things that matter in the options world: direction, duration, and of course, volatility. So how long you're in that trade really matters for options. And this direction, yes, you can use advanced options to kind of mitigate that, but I want the volatility. I'm not someone who's trying to avoid volatility, and that's a big difference. I think a lot of traders are, in fact, the opposite. They're consensus, which is perfectly fine. And the majority, by the way, are consensus traders or investors. They are trying to stay with a trend with no volatility whatsoever. That's perfectly fine. And then they use option tactics potentially to like sell calls against. That's one strategy. I'm very much directional option trader. I want to use spreads when I don't think there's going to be a volatility move. I used finance call spreads in more of the trend trading because I like this idea of having a directional bias, but letting time, if you will, create the value and direction. So I'm still always going to be a volatility girl, no way about it. This time frame congruence is more about trying to find a pattern within a pattern within a pattern. So I took this image yesterday morning, and I don't know if you can see this very well because I had to move from the screen, the presentation, but I want to try and show you this. This is Boeing, right? Now this has been a fabulous short into consolidation. This particular pattern looked like it was about ready to break higher, right? And I'm watching this. It fails every time at the 21-day on it. This is a daily, that's a weekly, and that's an hourly. So it has been repelled at the 21-day, which happens to be the dotted line. rejected, rejected, rejected. But I'm looking at this pattern going, I think this puppy's going to move higher. So on this day, we had a beautiful bullish engulfing off of a key support level, and it had a nice scoop pattern with a gap up. I said, I think this thing's going to move. So this is, hopefully you can see this. Hold on, I got to keep changing it instead of screen. I have doing application. So here's an example where Boeing yesterday, it pushed higher through the 21, through that trend line, and you can see this pattern now, I hope. So it's an example of time frame congruence right here, real time, where it had this explosion. I was counting on it, right? I want volatility. I'm patient, and then boom. So this was one of those cases where I said, I think it's going to go through the 21. I think it's going to go through the trend line because I've been waiting, and each time, now it's there. So, you know, maybe we get up to the 155 target. This morning, it actually pulled back perfectly on support. I haven't moved anything. This trend line's been there, you know, it doesn't matter, since April 7th. I haven't moved anything. It came back intraday. This is the hour, right? So this is a chase if, you know, you're interested in maybe taking that long. It's a low risk entry long above the trend line. On a swing basis, it's clearly gapped up, nice expansion bar, and then we have a nice pullback to support. Do we have a, look at this, a potential trend reversal? Maybe. And I say maybe because this is simply a pattern that creates a potential trend reversal, but it's not in my book until it gets back above the 10-week. So something for me that defines in trend is above the 10-week moving average. And when it's below the 10-week, it's obviously not. So this could, yes, easily head right back up to this up to the 10. And the 10 happens to be this 155 area, for example. So then the option tactics are a little bit easier to figure out in my head, because I want something that's going to be explosive, that's going to be nearer term, like a chase. Maybe even today with this low risk entry, it's going to stay supported, right? This low, let's say 131, it's already up to 135. It's going to hit its head because this is Bollinger Band. We got, you know, some resistance here at this fib level, but the point is it looks bullish, right? So for me, an option would be a weekly chasing this. A swing would be a monthly positioning into, like, let's say the $42 area. And then a trend would be positioning with probably a spread up into the 155, 160 area. Does that make sense? So chase, swing, trend, weeklies, a monthly, and then a few months out. And I would put it typically as a spread or a finance call spread. I wouldn't really do it with this one. I would do it more likely a finance call spread with Gilead. I would just do a straight spread. So Gilead looks a mess right now because it's broken the 10-week. I'm waiting for this to pull back and support. Why? Yes, it's potential coronavirus, but a bigger issue is I've traded this a lot. And in these financed call spreads where you're buying a call, selling a call, and then selling puts against it, you bring your cost basis down just to like 10 cents, 20 cents, 30 cents a contract. And you're further out in time, like June or August, as long as it stays above, let's say, you know, 67.50, this to me is a higher value play, because should this bounce and head up to 86.90, it's going to return many-fold, which has happened before. In fact, the luckiest that happened was right before an announcement, and I have a YouTube video on this, and it was honestly the biggest, craziest move ever. But Archana had suggested the option. I want to do a finance call spread, and she said, how about buying a call spread and selling a put spread for scratch? It basically came out to be like a penny. I said, I'm really bullish, so let's do that. It ended up going up 25,000%, which is a freak of nature, never happened before, ever. But my point is, they can be surprising. So now I'm not in this, I'm not interested in this because it has come down below the 10-week. It's coming back into this long-term trend line. But the macro case behind it is that there is still a lot of selling, a lot of lost money, if you will, in here for several years. We call it a widow maker, but it is still broken out. It still has the COVID-19, vaccine watch list and news headline, good or bad. You can say against all the vaccines, but the point is, for me, this is still one that I like to watch and play. Boeing is a more recent one because of that formation, if that makes sense. So that's Timeframe Congruence. And then risk management. What does that look like? What does that feel like? Because I'm obviously doing different time frames, multiple trade setups, patterns, macro, all that stuff combined. What does it really come down to for a trading book, for a structural way of approaching trading? It's trade, for me, it's trade small but frequently. I like to trade small, 1 to 3% of available equity. Some go right in there with 10%, and they don't trade so often. But I am, I'm kind of curious. I like to see, I typically every day come up with at least 5 trades. So that means I have to really manage how many trades I'm going to have. So in this particular case, that means it's going to be a smaller percent of available equity. The trade momentum for me is both directions. I'm agnostic. I don't care up or down. I was wildly bullish the IPOs from November into the very second week of February. And then I said, they're tired, I'm done. And all those videos, by the way, are on my YouTube channel. So I don't have very many of them. You can really see the trend, the progression. So Chase is like 20%, of portfolio. But because I'm trying, that's my goal anyway, trying to anticipate volatility, like that Boeing trade, for example, that just popped yesterday, or the Gilead, which, that was dang lucky, but I've traded it a few times, so I know the behavior of the options. I like to enter a stock, index, asset class, I don't care what it is, when it is extremely overbought or extremely oversold, when I see a trend reversal signal hitting, and then I like to put it on a swing time frame. So that's more my kind of bread and butter, if you will, is the swing portfolios, the swing time frame. There's adjustments and such versus the chases where you really have to be eyes on the prize. And then positioning plays are more of the value plays, or things that I think are potential M&A, right? So those are longer term, out in time. You think it's going to be a fabulous new platform, it's a new cloud play, and it's going to be a fabulous new platform, and you're investing in that thesis, and it might be a little rocky for a few months until it really gets its bearings. I was excited about, no, I can't show you because I've switched the scenes again. Anyway, I'll show you that when I go back to the straight charting software. So lawyering a trade, to me, though, is still about being able to take the bull and bear argument at any time. And then the major, risk mindset is just not willing to risk more than I'm willing to lose. And I think I approach that pretty well in my macro write-up as well. So let me show you what I mean by that. In my website, I have this particular approach, which is macro to micro. And what does that mean? Again, this is my website, but my particular approach is, for example, back in this January 28th, and I wrote this long, article for clients, this long post about coronavirus, perfect storm, coronavirus and market risks. And I like to look and let clients know what I'm thinking about as risks. And as we got deeper into this, it became very clear, and deeper meaning we only had 2,800, cases reported by China, and we're in the millions now. But the point is, life preservation meets capital preservation at some point. And I was early on this theme But this is really the point where I'm using that as a backdrop to then look for price action that's going to, act like it. And we didn't have that until February. So even though we had a month earlier, I wrote that post for clients, we didn't have any of that at all until the, 19th, 20th, 21st, 22nd of February. So for me, the macro is looking at this incredible intermarket weaving, if you will, of patterns, but also underlying themes and tells of when we are going to roll over and when we're going to pop. I do this review, if you will, for not just stocks, individual stocks, which of course is a lot of my live trading room, but also themes. I'm dollar bullish, but we haven't moved. We had a 10 standard deviation move back in March, but this is very different now. We're kind of consolidating these outsized moves in currencies. The Eurozone, and particularly, the Euro. This is a combination of macro with the technical analysis and intermarket analysis that makes me time these types of moves, and then clients can put their own envelope of risk, to it. So it might take a little bit longer than expected, right? It's not a day trade. So, but these charts, if you will, or this analysis that I provide is what helps folks stay in or out of a particular trade. And obviously, I'm using this as my backdrop also to identify good trading opportunities, like this gold and SPX relationship showed very clearly that gold is staying bid. This was obviously back in before the drop. We have stayed solidly where gold has obviously continued to stay bid up. But this type of thing gives more credence to a position and staying in a trade. Does that make sense? Recently, I said, I think TLT is going to pull back. We're going to get a yield pop. And this is not your normal, chart analysis, if you will, but this has proven very helpful as yields have popped recently. Value also levitating, if you will, home builders. I've got a wood, like this is wood, goes with home builders. So commodities going higher, also the oil trade into tomorrow. This is retail, how I relate, if you will, or interrelate the movement of XRT to SPX. This is a potential inverse head and shoulders. Be on the lookout for moves higher in retail. Why would that move higher? IWM, KRE is a big component of IWM. So I'm looking for themes, during the week, during my newsletter, to then in the trading room capture in actual trade setups. I hope that makes some sense. But that's basically how I do it. And one of the reasons why I am showing you this is it's great to have a narrative for a trade, but it's also extremely helpful, I think, to have a little bit of roadmap. And this roadmap for technical trading on the 23rd, I'm like, okay, this is solid support. We should bounce. We did, and obviously we're up to the 61.8 retracement in the SPX, and we have just today filled the gap in NASDAQ, the gap down from that February 24th drop. I think we have some risks that are absolutely real, but this is where I'm focused, is the backdrop that then translates into actual trade setups that I'm spying in my trading room, and then have a little bit of follow-up as far as trade management, options education, newsletters, all that good stuff, videos, and a little bit of a fun little new thing, which is I have a break for clients that want to do a little exercise program. So after we work really hard in the trading room, take a little break, stretch, and then go right back into trade management and options education. And this is what I'm offering to you in this particular summer trading program for June, July, and August to come fishing with us, do some exchange, if you will, of ideas on trades that look good across multiple time frames, and then basically have an opportunity to get some custom engagement, custom consulting, if you will, as well as my analysis across different platforms, different, I should say, time frames and different portfolios. Steve in my room does quant, Archana does advanced options, and then we even have a stock fit class. So I hope that helps. If you have questions, now would probably be a good time. And yes, there is a summer trading link that David has just offered. Thank you very much. And then my website is LaDucTrading.com, and you'll see also, you know, some of these videos if you want to take a little look around, like the guild that popped, you know, 250 times, which is just unprecedented, that kind of thing. But watching me live, like I literally was calling the oil short before it fell. No, I did not expect it to go down to -38. Nope, didn't expect that at all. But this, I mean, was live from my trading room. So I do have some examples that you can take a look. I do commentate on macro, which, for example, this particular, I did a Stock Charts TV recently. I have, thank you very much, Anka and David, for inviting me a few times. We had a women's trading event, and I talked specifically about option flow, and the option flow I thought was very interesting for me to actually put that presentation together, because I had forgotten how I take that for granted. I don't use just regular, let me just show you real quick. There we go. I don't use just unusual option activity and chase anything. You can already tell I'm not doing that. I want very much to have a narrative fit a chart. And then I look for the flow to kind of support that move. And I want large flow. I'm not looking for just one-off odd stuff. Has to be a liquid name. This chasing business that's going on this particular charting platform, I can show the option flow for the particular day under volume. Open interest isn't so helpful if I don't know exactly how the option order was entered. In other words, were they selling or buying? And, you know, many at a time or one big order. This I can show, okay, yeah, they're positioning a little bit as a chase, and then we've got some June 135s. You know, I like to see what's coming in for sentiment and option flow when it comes to order flow, but I'm also looking at the quants. And the quants I'm talking about are the CTAs that have the most asset under management, and they're the ones who are positioning with their gamma, which is basically negative or positive gamma, and it feeds on the buying or the selling. And there are certain trigger levels that can create the structure in the market of big buying and big selling. And I'm talking big buying and big selling. So under the surface, I'm using some other kind of tools, if you will, to identify what's happening with accumulation and distribution, and if it's a good day for trending, or if it's a good day for basically not trusting the market price. So these are all things that I'm looking at as it relates to identify what's good for a chase, a swing, or a trend, and how I'm using options in particular based on the time frame. And then what I have going for trades right now is waiting until the end of VIX expiration tomorrow, which is, I don't know if you're familiar, but Wednesday is the VX expiration. And I have macro concerns that are definitely going to be on my radar for risks. In particular, if you're into that type of thing, rates and dollar, and these are not usual. So this is a dollar chart over many, many years from the 80s, and it is still percolating higher. And if you're familiar with the dollar, kind of makes the weather, and it can reprice or can add a lot of volatility into the the equities market. The Fed is trying, obviously, to break the back of the dollar bulls, but for right now, it is still percolating higher and is a big market risk. We also have, if you're taking a look at this chart right now, I have the 2 and 10-year yield curve. This is very much a breakout and help time that pullback in February. Well, it is unprecedented, just like the unemployment claims we've never seen. But this is the highest rate of change in this bull steepener ever. And it is going to, at some point, need to normalize. And when it does, yields will pop. And when yields, the 10-year yield does rise, like it looks like it's about 2, more than just yesterday, then we will have potential for tech to sell off. And that rotation of tech selling off, bonds selling off, typically will flow through into oversold value plays. So in other words, when yields rise with commodities, if you will. So we'll see if that actually comes to pass, but that has not yet rolled over. But it's definitely something that I'm watching. And these are the types of, if you will, intermarket charts that I am spying for clients, because they help create the themes, if you will, like the inflation expectations started rising in April very strongly. We also had the oil fall out of bed and then pop with commodities. So this is the backdrop against then figuring out, okay, so how long is this likely to last? And I caution on the TLT, for example, that rollover, if we get more than, basically it's 1 hour, if it closes on the highs, like the 10-year did yesterday, next day, does it close on the highs again? And then on the third day, does it close on the highs for a third day? Then for me, that's a much higher probability swing. Otherwise, it's just a chase, and it can just as quickly revert and head back down into its trend. Does that make sense? So macro for me is the backdrop, and the biggest risks that I have right now are, of course, the dollar has been sideways, but is bullish. And this yield curve has a look of yields popping and TLT coming down a little bit. So that will make some of the weather in the equities market. And I have, goodness, value plays from commodities to retail that have been percolating the past few days and look like they have some more to go. And I think this is that's a chart of retail, for example. If we push through in the next few days, that will confirm, again, a little bit more of a bullish look for small caps. And when yields pop, that's also good for banks, whether it be KRE, which is regional, or XLF, which is the big banks. Where the heck am I now? Okay, good. So long story short, I have 2 sites if you want to take a look. One is this free bait, which is for signing up if you're interested in fishing videos that I do, any blogs that I do. Obviously, if you're interested in more of the macro, not trade ideas, not here, then have a look at my website and then the YouTube videos if you want more of a play-by-play on what I'm looking at on occasion. I have this summer trading offer if you're interested in seeing a little bit more on, and a day pass versus week pass, which you could also come in and try. Hope you consider. Let me know what I can do to help. I'm very much a proponent of women in trading and want to encourage and elevate and make a very comfortable environment as well for my trading room. So there's lots of customization and engagement on ideas that you are trading. I hope you check it out. And I wish you, of course, a fabulous summer and healthy one at that. Did I hit the time? I'm not even sure what time it is. Oh, it's 2:54. Any last questions?
That's perfect.
Nope, then I'm out.